Adrian Helfert is Chief Investment Officer at Westwood Income Opportunity Fund. Thank you for joining us here at The Street.
Thank you for having me.
So you have a single best trade for us? What is it?
Yes, sir. Well, back in July, I looked at the single best trade being Crown Castle. Crown Castle, of course, as you know it, is a tower operator, primarily a tower operator. They have ventured into providing fiber and small cell. So when you think about that market, you think about providing data for the burgeoning data need that we have for our cell phone service, for all the smartphones that we're using. And this is really an aggregated market. It's kind of an oligopoly where you've got American Tower that's involved, you've got small business, SBAC that's involved, and you've got CCI that's involved. CCI is really the second largest in this. They've got about 40,000 towers. These are large towers where they have multiple renters involved on their towers, and they've got small cells that are aggregated into highly dense markets, and they've got fiber that provides much higher throughput for their communications. One thing that Crown Castle has, of course, is a more dense market operation base. So when you look around New York City and Los Angeles and San Francisco, this is a company that is, when we see reurbanization, they're going to make hay. They're going to do very well because they're providing that off-put of high data throughput through their small cell capabilities. And they've built that up differently than, say, the likes of American Tower. Now, the yields on that small cell have been depressed, and that's led to their depressed valuation. The yields on tower operations, the large towers, are better. And for that reason, they've been discounted relative to their peers. Strategically, CCI went into this business of providing more small cell, where their peers went into more international businesses. The market in the United States for towers right now is saturated. There's about 100,000 towers. As I said, CCI runs about 40,000 of those. And it's a saturated market. We're not seeing that 100,000 tower growth. We have what we need. Where we're growing is in dense urbanization and higher data throughput for areas where we need higher offput of data.
All right, so I don't assume when someone has a single best trade that it's always a buy. You haven't said whether you like it or not. You kind of described the context. So do you like it or do you not like it?
I like it. We hold it. It's a good yield for what it is. We think that there's several catalysts that are going to provide upside to beyond the yield. This is a real estate investment trust. So we're looking at measures like adjusted funds for operations on where they are, and primarily we're looking at a discount on their EV to EBITDA. It's a cash flow business. Because it's a real estate investment trust, we think there's a discount right now of around 2 to 3 points relative to its peers because of the yields that they are currently getting on their small cell. The catalyst that we're going to see to then realize a better stock price for them is going to be number 1, 2, and 3 is the involvement of Elliott the activist. Elliott the activist has pushed for a replacement of their CEO, which they received. And guess what? They hired a CEO they hired an individual that was heavily involved in the grow out at American Tower. That person is now the CEO of CCI and is going to lead the efforts to provide higher yields and yield targeting for the new capital allocation for their business. That will bring their multiples back to their peer levels, we believe, and provide an upside to the stock.
So you see Elliott Management shaking things up. That's a plus for you as an investor. You see that as a positive.
100% in this case. And that's not always the case. In this case, Elliott has come and identified areas where they can improve their yields as a real estate investment trust. They've identified, number 1, leadership, the board membership. They've also provided guidance for how they should actually look at yield targeting for capital allocation projects they go in. And so they're going through a strategic review right now. We're going to see the results of that strategic review, we hope shortly. We don't know when that will happen, but one of the possibilities of this strategic review is selling the small cell and the fiber business, of realizing that out and refocusing capital allocation on either better yields in the tower space or even better returns for the shareholders.
So sometimes an activist investor can go too far and shake things up too much and cause too much distraction. Is that a risk to your outlook on the stock?
In this case, they've been involved for a while. So this is not a brand new involvement of Elliott. They were proposing this back in 2020. In 2023, they went through a re-involvement and went through and reproposed all the things and they pushed for things like the changes. So at this point, no. And the new CEO coming in, that is an ex-AMT individual that's experienced in the growth of that business is highly positive. And so his leadership, we believe, is key to the business and key to the strategic review of what they're going to do. So we see a good catalyst in the future. We see good yields. We see a depressed valuation we think can be realized.
So the stock is in a 52-week range of about $92 to $120. So right now it's pretty much in the middle of that, around $100. What's your time horizon for the stock?
The near-term catalyst is a nice thing to have, because right now we're trading, you're right about the mid of the range. We think we can trade up to 120 pretty quickly if we see a strategic review that identifies those things and has a capital allocation plan that is better, and potentially selling those small cell and fiber businesses and focusing on higher yield businesses for what should be a higher yield company.
So there have been talks, of course, about M&A, right?
Yeah.
About them spinning off the fiber and the wireless assets. What would that mean for the company, and what would that mean for the stock?
Well, them doing that, there's a lot of differences between the traditional tower business and small cell and fiber business. One of those certainly is the duration of the contracts and things like CPI escalators that they have on these contracts. What that means is things like rate sensitivity. It's really topical right now, of course, because we're at elevated rates and we have a potential dropping interest rate. Or maybe it's going to be elevated if we see inflation kick back up because of fiscal policy, et cetera. It's going to make them more duration sensitive potentially. They're already very duration sensitive. And I'd say that's one thing we've seen. When we talked about this back in July, it appreciated very nicely, but it did so in a lot with the appreciation of the 10-year U.S. Treasury. So yields dropping, the price going up. It's going to be more duration sensitive in the future, and that's one key output of what they're doing.
All right, you talked a lot about the benefits. So what are the risks to this stock?
Well, risks to the stock are that out of the strategic review, they decide to, I believe that they decide to keep the business and be less sensitive to their capital allocation yields that they're providing. That would be a negative. They're going through some churn right now on their Sprint subscriber base. What we really need to see is we need to see that offset by growth in their subscriber space, and the renters on their towers increase. That increases the yields. If you have a tower that has one tenant on board, your yield is not as good as if you are aggregating and have 2 or 3 tenants on board. So we need to see that happen as a positive. If we don't see that subscriber churn from the Sprint acquisition that happened and now moved over to things like T-Mobile and AT&T and Verizon, if we don't see a pickup in growth there, that's going to be a negative for them, but we believe we will.
So you've mentioned the strategic review several times. What's the time frame for that, and what's your patience level for the time of whatever decisions are going to come out of this review?
Very good question on the patience level for sure. Time frame on that is, as I say, Elliot's been involved for a while. This isn't a new thing that we then worry about. Primary losses of key individuals at the firm. We've already seen the turnover we need to see, that they've actually been looking for in many directions. We are going to see, I believe, a resolution on the strategic review that is in the coming months. My patience level is not extraordinarily high for that catalyst individually. I want to see the outcome of that, and that outcome, I believe, should be, I'd call it within the next 3 to 6 months, where we'll start to see not only a statement around that, but whether they're going to live up to the statement and start performing the duties that they tell us that they're going to do. If they're looking for a buyer of those assets, give us an indication of what the valuations that they'd be willing to accept on the valuation of those assets would be helpful as well. It's not a long-term time frame. As I say, I talked about this back in July. Some changes have happened on the 10-year U.S. Treasury, and this is still a duration-sensitive orientation. So you've got a macro influence on the stock itself that investors need to think about, because if we see drop in rates, that should be very good for this company. If we see increasingly rising rates, that could be some difficult headwind for them. They've got a load of debt still. We need to see more information on that. So it's probably 3 to 6 months as far as my patience level.
Your single best trade is Crown Castle, ticker symbol CCI. And we've been speaking with Adrian Helfert. He's the Chief Investment Officer at Westwood Income Opportunity Fund, and this is The Street.